Hello, this is Chuck Stull, and I'd like to look at market structure. As we've seen, returns to scale give advantages to big firms, at least if there's economies of scale. Economies of scale means that bigger is more efficient in the sense of lower cost. And this applies to many different industries, where having a large factory, a large production facility, has lower costs per unit than does a small production plant. But this won't always be true. Consider a restaurant. Why not have a restaurant with 40,000 seats? Well, it's obvious that food would be cold, it would be so hard to organize, people would never get taken care of. So there are limits to economies of scale. In some industries, with some technologies, limits come very, very quickly. If we look at something that requires personal services, tailoring, or dentistry, the um, the connection is one-to-one. It's hands-on. There's not a big advantage to being a giant tailor firm or a giant dentist practice. And in many cases, we do see these as sole proprietorships with a single professional operating the store. At the opposite end of economies of scale are diseconomies of scale. So diseconomies of scale exist when a firm gets too big. As a firm gets larger and larger, at some point the cost may start to increase. The average cost may go up, and that means that a smaller firm would be more efficient. We certainly would be worse off operating in the diseconomies of scale region. Essentially, returns to scale can be either favoring large firms or small firms, depending on the specific technology. And the returns to scale and the technology that's related to that determines the optimal size for the firm. What we want to do is take advantage of any economies of scale and not push into the diseconomies of scale area. Once the firm size has been determined, that will then determine the market structure. If we have diseconomies of scale, then smaller firms will be at an advantage. Smaller firms will be at lower cost, and we would expect there to be many, many competitors, and so the market structure would be relatively competitive. On the other hand, if there's large economies of scale, right, economies of scale mean that the bigger firms would have an advantage, then it would be more efficient to have large firms, which means each firm will have a higher market share and will have less competition than we would in the technologies that favor small firms. Now, there's another factor we haven't discussed, but it still can be important in determining market structure, and that is consumer preferences. While it might be really efficient to make everybody's clothes exactly the same, because we could just make these huge production runs, not ever have to change, this might not be very desirable from a consumer point of view. So from a cost point of view, making identical clothing for everyone could be efficient, but it might not match what consumers really want. So the idea of product differentiation is that there are some cases where consumers are willing to pay more to have a variety. And some consumers will choose one item and other consumers will choose another item. And this can play off of economies of scale. It might be worth it for some consumers to buy something that is specialized, that is somewhat unique, that is different from what other people are wearing, and they may be willing to pay a higher price just to have a choice in terms of the quality of the product. And we see many, many consumer goods where product differentiation is super important. People don't want to purchase commodities for certain kinds of goods. So let me look at market structures as we commonly classify them. There are four main market structures. Competition. Competition is often what our supply and demand curves assume. Monopoly, when we have a single provider, and oligopoly, where we have a small number of providers. A monopolistic competition, which is the most confusingly named, where we have many firms but with products that are differentiated. So let me walk through each of these a little bit more slowly. Competition, we're looking at many firms selling identical products. This means we're looking at commodities where you can't tell was the product produced by one company or another. We will see no brand names. We will see no individual advertising in a competitive industry. There are very few industries that are purely competitive because many of the commodities that we might look at, like oil, where we might not differentiate from one company to another, are large. So we're mainly looking at some industries in agriculture, some industries in very basic commodities, maybe wood pulp or other kinds of um, uh, products like sand or gravel where no one cares about the brand name. The opposite end of that is monopoly, monopoly which you will read about or have read about. Monopoly has a single firm. The monopoly is a price chooser. The monopoly has no close substitutes in the market. There are barriers to entry to protect the firm from entry. And essentially, the monopolist just needs to consider the consumers and try and figure out how much they can charge to maximize their profits. Monopolists, again, are not super common. We have certain kinds of public utilities like electricity or water delivery. In some places, internet service, there may be no choices. Um, and we have certainly patented products where there is a legal monopoly for a brand new invention. Our third market structure is one we see very, very frequently in the real world, and this is oligopoly. Oligopoly exists when we have a small number of firms, firms who are interdependent. They recognize that their actions will have an impact on others. These would be highly concentrated markets, ones where we may have a lot of economies of scale, or that the firms are large relative to the market. These firms may be selling products that are indistinguishable, things like a particular grade of steel or a particular grade of oil, or they may sell things that are differentiated, a soft drink, a running shoe, a automobile. Our fourth and final market structure is the one that has the most complicated name, and this is monopolistic competition. Monopolistic competition looks a lot like pure competition or perfect competition in that there are many small firms, each competing in the overall same market. What makes it different here is that the products are not identical. So rather than being a commodity where everything is identical, we have product differentiation. There are characteristics or qualities of the products that some people would prefer and be willing to pay more for. Monopolistic competition is common in retailers, in fashion, in certain kinds of furniture, and in some other sectors of the economy. And we'll look more at these throughout the course. Thank you. I'm Chuck Stull from Kalamazoo College.